So Mint is the largest actively managed bond ETF out there on the market. So naturally, investors want to hear your outlook on rates. How is Mint positioned for 2020?
Mint's positioned simply for capital preservation, liquidity management, and managing volatility within the broader marketplace. Quite honestly, what we think about where we are in the current environment is that optimism prevails, but uncertainty reigns. And we see a lot of potential obstacles which could emerge at any point in time, whether they're geopolitical, political, fiscal, monetary policy, which appears to be on the sideline at the moment. The reality is the culmination of these events could actually lead to a certain amount of uncertainty for investors as we get further on into 2020. So thinking about that in a more healthy way, having a more balanced approach to liquidity management, having a more balanced approach to portfolio allocations, which help reduce the exposure to volatility, is really the segment that we need to be emphasizing to investors as we embark here at the new year.
Okay, you mentioned monetary policy on the sidelines. You hang out at the short end of the yield curve. Right. How confident are you with the Fed's handling of the repo market disruptions?
Right, we've avoided the Repocalypse, so to speak, and really what we've seen is that the protocol that the Fed has put in has frankly alleviated a lot of the symptoms within the repo markets. At PIMCO, we actually look to see the repo markets as very much a focal point, a barometer of the overall health of the capital markets, the cost of capital in real time. So for us, it's just as much as a real-time warning system to what capital could be doing, moving and fluxing throughout the marketplace, as it is an opportunity set. So when repo rates moved higher in September and October of last year, we viewed that as to be an opportunity. So as an active manager, we segued into those markets. But really what we need to be focusing on is that these are going to be temporary episodes of liquidity. And again, for investors, what they need to realize is that ultimately the cost of liquidity is overestimated, meaning people just take it for granted. We need to be utilizing that with a more proactive solution. And that's exactly what we utilize in the short duration space at PIMCO.
All right, we just showed a chart about cash battle, and I want to talk to you about cash sweeps because they're back in play with Schwab and Zero Commission Trading and a bunch of other firms as well. You recently wrote a blog post making the case for using Mint instead of keeping cash in money market funds, taking a bit of risk for a bit more return as well. What's the risk of doing so? What could go wrong?
Well, most of the strategies that we have out there are same-day liquidity, T+1 liquidity, we like to call it. The reality is that when you move to that segment of space, you are taking a little bit of risk, meaning, one, you're moving into a slight credit space. Again, it's high in quality credit, but you're actually getting compensated to do so. So you're earning generally between treasury bills plus 60 to 90 basis points. Mint last year produced a gross return of about 3.5%, a little bit more than that. So there's a fairly healthy compensation in doing so. At the same time, maintaining diversification in your portfolio, being up in quality, and most importantly, earning that kind of yield with having a very short amount of interest rate exposure is actually something that's quite attractive in the portfolio positioning for clients. So what we're really finding is that the clients are wanting to avoid zero returns, so cash sweeps. They're wanting to avoid T-bills, which are structurally subdued lower, and are looking to take that incremental position not only into short-term space like Mint, but into low-duration spaces like low-duration ETF, LDR, to sort of garner that income and earn those liquidity premiums within the portfolio. And that takes an active, cognizant allocation for investors to take that additional step.
Right.
So the zero fees actually incentivize people to take that step and actually look to their portfolios to see how they're actually properly managing their cash allocations.
All right, now I wanted to ask you as well about your new fund. It's a sequel to Mint called Emint. And according to Bloomberg Intelligence data, there are some 102 ESG products out there in the market with an average of $200 million in assets each. That's more than an average of that's a lot lower than the average of $1 billion for other ETF categories, as you can see right here. Where's the demand for ESG funds going to come from? And how come it isn't here yet, despite all the hype?
Well, quite honestly, it took a long time for us to be talking about fixed income ETFs, and fixed income ETF growth has actually done quite well, doubled over the past 2 years.
From a small base.
From a small base, granted. And right now, actively managed fixed income ETFs represent 10% of the fixed income ETF universe. So as we sort of see this, we're combining it with a new theme, which is ESG investing, social governance, people being socially aware with how they're allocating their cash.
Sure.
So the natural segue is for investors who have cash management, who want to think about capital preservation, but who are yet socially minded, to combine those two. So we actually think there's fairly healthy demand, not just within the short-term cash space, but within the ESG product space in general. At PIMCO, we started our ESG efforts back in 1991. So this has been a long-held tradition at PIMCO, not only in terms of thinking about credit risk and thinking about proper investing, but also looking to bring that to clients. So what we're doing is simply piggybacking off of our enhanced cash expertise and using our platform for ESG products and bringing those together for investors. So we're quite excited about it.